So continuing with diversification and portfolio risk, now that we calculated standard deviation, we're looking at annual rates of return for the market, basically showing how many years the market had certain type returns, and showing you the frequency of occurrence for the last 117 years. So basically, this can help us to predict, how likely would a certain return happen in the future, statistically speaking, right? So again, this is how we compute our variance from the mean, and then we add them all up, all the squared variances, and then that's variance RM, and then the square root of variance RM is the standard deviation. And the standard deviation is basically noted by this symbol here, and the variance by the symbol squared. And here's another simple example of how to calculate the standard deviation. And you can go through it here, basically looking at how much it varies from the mean, and then we actually sum it up and square root it to get the 21 here. But basically, we're looking to measure the variability, and again, the standard deviation measure for the common stocks, we have 19.7 here, so we actually calculate, because this is a bit of a different period than we calculated, so it's a little bit more, but very, very similar. And for government bonds, 9%, and treasury bills, 2.9%. So with that said, we're looking at the markets around the world, risk-adjusted, the standard deviation. So here we see, if you want to look at how risky are different markets around the world, you could see that the risk actually goes quite a bit up with different countries, saying that the variability of returns is quite a bit higher. And then in here we can actually see the standard deviation for selected U.S. common stocks, for specific stocks, for specific companies. And as you see, for specific companies, the returns are the standard deviation is actually quite higher for specific companies because there's a lot more volatility. And this is where we can see, even internationally, the market standard deviation compared to the stock standard deviation. So you can see that the market overall has a much lower volatility than the actual equities, because some of them actually vary quite a bit. We can see here, for example, in a portfolio, the more securities you have, the less market risk you have. So that is why diversification is so important, because as you see here, for example, in Tesla, standard deviation of 57%, United Steel 73%. So it varies so much because of the volatility, and Amazon 26.6%. So of course, when you're looking for and to invest in a stock, a lot of times we're just talking about, what is the return going to be like? And really this question of standard deviation really shows you the risk. Yes, you could have a certain return, say Amazon has a certain return, but you have to live with the average volatility of 26%. And that is something to think about when investing in stocks, is what would be the risk-adjusted return? In other words, what will be the return compared to the volatility? And you want to achieve ultimately a high return with a low volatility, and that provides a better risk-adjusted return.